So, ladies and gentlemen, dear friends of BRS, the Belgian Raiffeisen Foundation, I wish you all a warm welcome to this 8th edition of the Microfinance Lunch Break. For ADA, our Luxembourg partner, with 22 sessions already gone, the Midi de la Microfinance in Luxembourg already has a long tradition. But with this 8th edition here in Brussels, these Microfinance Lunch Breaks also are becoming a landmark in the Belgian financial and economical circles. As a lot of you are already aware of, the aim of the Microfinance Lunch Breaks is to raise awareness and to increase the interest for the challenging world of microfinance and microinsurance. And today, we go already through the 8th edition, and as a lot of you can state, there is an ever-increasing interest for the subject. And as promised earlier, we will try and alternate the subject between microfinance on the one hand and microinsurance on the other. BRS is convinced that with ADA, Fabelfin, Assuralia, KBC and SERA, it has strong partners who are convinced of the important role of microfinance and microinsurance and of the role it has played and has to play in the future. And they are willing to support this initiative very actively. I especially would like to thank KBC, our valued partner of BRS, for their support and generous hospitality for our Microfinance Lunch Breaks. We kicked off the first edition of the Microfinance Lunch Break in February 2009 with Damien van Stauffenberg from Microrate, who dealt with the issue of the impact of the financial crisis on microfinance. Since then, through a number of well-known and experienced speakers in the review, we discussed a variety of issues of the world of microfinance and microinsurance, ranging, amongst others, from regulation over risk coping mechanisms to governance issues and so on. And so, we are here again today with a new question. Microfinance as impact investing. But what impact? Question mark. Impact investing is the so-called new kids on the investment block. The term is brand new, but the practice it refers to already exists for quite some time. Microfinance, for that matter, can be seen as an established form of impact investing avant, lettre. It is assumed to make a positive contribution to societal change. Impact investing differentiates from previous attempts to combine investments and social, environmental, cultural, and non-financial outcomes in two ways. It also attracts investments aimed at market rate returns, and it attempts to measure impact in a systemic way. Today's presentation will focus on the importance of impact measurement from the viewpoint of a forward-looking investor with a special attention to microfinance. Eventually, there will be a comment on the future of microfinance as an impact investment branch. For sure, an interesting debate since the financial sector at large and microfinance in specific have become a kind of evergreen subject to discussions nowadays. This challenge will be addressed by our honored speaker of today, Professor Dr. Harry Hummels. Dr. Hummels is European Liaison of the Global Impact Investing Network and Managing Director of SNS Impact Investing, the development investment arm of Dutch bank insurer SNS Reaal. He is also a professor of ethics, organizations, and society at Maastricht University, with decades of experience in socially and environmentally minded finance and business academics. Dr. Hummels has cultivated an extensive network of impact investment professionals and has actively promoted impact investment principles and collaboration among investors from different parts of the world. So, ladies and gentlemen, once again, we have a challenging subject and a renowned speaker. Professor Hummels will now share his scientific and field experience while focusing on impact investing as the new kid on the investment block. Together with you, I'm looking forward to a fascinating discussion about this matter. After the presentation of Professor Hummels, there will be a question and answer session, followed by some closing remarks addressed by Loïc de Canière, CEO of Incofin Investment Management. And Incofin Investment Management itself is a founding member of the Global Impact Investing Network. So, Professor Hummels, the floor is yours.
Ladies and gentlemen, good afternoon. Mr. De Pickering, thank you very much for your kind introduction. I'm absolutely honored by the invitation, and I'm really grateful to be here today and to share some thoughts on the topic of impact investing, and particularly focusing then on microfinance, the relationship with microfinance. But before I do that, I would like to, as the title says, Pantere, everything flows. I'll come back to that later, but before I would like to go into the subject matter, I would like to take you with me to a Protestant church, the one that I recently visited. I'm a Catholic, like probably many of you, but sometimes you get to know people, and I recently had the opportunity to listen to a sermon of a Protestant minister, and I would like you to imagine that there is this Protestant minister, and he was really excited about his pension fund. And that was intriguing, because actually he was giving a sermon on international development. And then at the end, he basically said, I'm quite proud to see that we can not only talk about it, but that my pension fund is actually seriously involved in something like microfinance. His pension fund invests in the SNS institutional microfinance funds, and he was really pleased with that idea. That basically brought the question back to the table. This is an institutional investor, a pension fund. What is the relationship between those institutional investors and what we nowadays call impact investing, of which microfinance is actually a practice avant la lettre? So, actually, I would like to share a couple of thoughts with you today, starting indeed with that sermon that I had the opportunity of overhearing. And it goes back in time already quite a while. Impact investing might be, as Mr. De Pickering already said, it might be the new kid on the block, but the practice behind it is already well established. Going back indeed to 1760, another minister, John Wesley, a Quaker, who was basically in his sermon, the right use of money, addressing issues like investing in weapons, tobacco, alcohol, but also in positive change. So what we try to do with microfinance, and certainly that pension fund was trying to do with microfinance, is actually part of a long history. But let me first say something about impact investing. As Mr. De Pickering said, it distinguishes itself from, let's say, microfinance, the regular microfinance practice that most of you are very affiliated with. Impact investing definitely also focuses on bringing in large institutional investors, bringing them in with financial motives, not only social motives, and focusing then on the question, but what impact do we really get out of that investment? Everyone believes that it's wonderful if we can invest for creating a good world, a better world, while making a solid and decent return. That is the ideal. But then the question is, what is the actual contribution of those new kids on the block calling themselves investors, impact investors? It will certainly not be an easy task, as I will probably show in this short presentation, because there's a lot of money then, if institutional investors come into the field, there's a lot of money moving in the direction of maybe only a few investment opportunities. So, is it really creating added value for the sector and ultimately for the microfinance institutions, for instance, or other social investees, that so much money is coming to the place. All right. Let me, as I said, first define the subject. Basically, we're talking about the allocation of financial resources to a broad spectrum of social and environmental objectives, going from, of course, microfinance to some issues like affordable housing, healthcare, clean water, education, all very important social objectives. And bringing in that money is not only done for the social purposes of those investments, but also for financial reasons. Impact investors usually do believe that they can get a solid, decent return out of making that investment, while at the same time creating some good for the society they're operating in. But we have to be wary about it, as I just mentioned already. Are we really able to create a better world through bringing so much money to the place? Are there sufficient investment opportunities? And if there are sufficient opportunities, do they then have the right specs, the right specifics for the institutional and other investors? All right. This is basically saying what it is. This is what the animal looks like. But then the question is, okay, is it able to create or help create a better world? And then I have to say, I have to start with something that we actually feel happening every day. We are in a situation of economic decline. Government is taking all kinds of austerity measures, and that puts pressure on the budget of the government, of public institutions, to allocate money towards social objectives and environmental objectives. So basically, my argument is, yes, it is quite welcome that private investors do step in if the government or if the public in general doesn't have the means, the resources, and particularly the financial resources, to support development in both our own countries as well as worldwide. And I'm particularly thinking of emerging markets of developing countries. So what we do see is that ultimately there's being put pressure on the budgets of governments to deploy money to development, something that we all think is very important. I don't know whether you've heard, but our Minister of Development Aid basically last Saturday said that development aid is something of the past. We now have to look at involving private investors into the area of development aid, because we need to be able to approach the issue of development much more from a business and investment perspective than simply from a social or public perspective. So there is, certainly in the years to come, probably a lot of pressure on the amount of capital to be deployed in development. That is why I think it's a good idea to involve private investors. So having said that, that's one. But then we have to be critical because, again, as I said, what is the added value of it? Yesterday I spoke with someone coming from Kenya who works for a Dutch development organization, and he is an advisor in developing business opportunities in his case, Kenya. And that was quite intriguing because he basically said, we definitely are at the beginning of the supply chain. We try to create new business opportunities where investors can come in, but we first have to start with actually developing solid business plans for businesses that want to attract capital. we have to come up with business plans, we have to come up with, indeed, the financial arrangements that are necessary. Most of the time, those entrepreneurs in developing countries are not very fond of attracting private equity capital. They very often prefer debt. Maybe that's even ultimately detrimental to the business they're in, but ultimately there is something like a preference for debt over private equity. He said, what we have to do ultimately is make sure that we help to create businesses that ultimately can be bought by other investors later in the sector to help facilitate growth. And we have to have first the fools, families, foundations, etc., to take the risk to help create that business, and then we take the next step towards involving other larger investors, mainstream investors, ultimately even institutional investors. So he was basically giving an overview of where you'd usually start and where you probably end up. You start with small private investments and you might end up with more public investments. But that ultimately leads to the creation, or there is a need for the creation of a financial supply chain. And we all have seen that sometimes addresses huge questions, particularly in the area of microfinance. We've seen come a lot of money, institutional money, as well as other commercial capital coming to the market. We all know the examples of Comportamos, Barnex, SKS, etc. And they are not always, or they haven't been always, focusing on the social welfare, on the social side of it. So why do we think that it makes sense? I think there are opportunities, but there are also limitations. If you look at what an investor is looking at, let's say that it is necessary to bring more capital, more private capital to development issues, then there are some potential barriers. And I've listed here 4 potential barriers. First of all, the size of the investments. Second, the cost of the investments, the complexity of the products, and the assurance of impact. Let me start with the size of the investments. If you work with institutional clients, institutional investors, such as I do on a daily basis, you notice that they, for reasons of deploying an enormous amount of capital, most pension funds are basically investing something like between 5 and 250 billion euros in the Netherlands, and 250 billion is our civil servants pension fund. They can only deploy that amount of money if they are able to make substantial investments. So a pension fund like ABP, actually the minimum size of an investment is 50 million euros. But you can imagine if such a huge investor comes to the microfinance place, then 50 million is a lot of money. 50 million is particularly a lot of money because such a fund usually does not want more than 25% of a fund. So that means that ultimately a fund investing in microfinance, if it wants to attract capital from a party, an investor, like ABP, at least needs to have a size of 200 million euros. And that's only one fund you're thinking of, but there are a lot of other competitors in the area. So ultimately there is an issue of size, and there is a certain danger that too much money is coming to the field. Secondly, the cost of making impact investment. There is a slight advantage in having those professional players come to the market. It brings market discipline, it brings a kind of professional behavior to those offering the funds to the investors and ultimately deploying the capital with the investees. But there is something about the cost that all these investors are currently looking at. So it's not uncommon that microfinance investors probably have a cost load of 200 basis points, 2% or more. Let's be honest, that is way too much for the institutional investors. So they put pressure on the amount of money that you could basically use, the funds that you could use for your own organizations, deploying that capital in development. And I predict that in the years to come, particularly in the institutional space, the management fees will ultimately go down to below 100 basis points, and that's basically unheard of at this point in time. So, but it is labor intensive, we know it, but we all have to step up to then be able to accommodate the needs of institutional investors. Thirdly, complexity. Complexity is definitely an issue currently because our financial markets are de-risking. We have an issue with risk, and if you go to your regulatory and supervisory authorities, financial authorities, then you will definitely find that de-risking is a major issue at this point in time. Also, what we see is, so we have a very complex financial system, but those who are offering microfinance or other impact investment products are very often small boutiques. The question is then, are these boutiques professional enough to meet the challenges on a daily basis that institutional investors require? And then you have to think of issues like risk management, all kinds of stress tests, etc. Are these boutiques able to actually deploy those services and report to their investors in a very professional way? And finally, there is the issue of the creation of impact. I work a lot with pension funds, and these pension funds ask me, Harry, it's nice that you make a solid return, that you do something to better the situation of those investees, MFIs, etc., in developing countries. But what is that impact that you're creating? And I can tell you that's quite difficult because it comes back to the debate that you've apparently had previously. Is the microfinance sector there ultimately to alleviate poverty, or do we provide access to finance to people who have not had the opportunity to access finance in the past? Or do we do something else, like the integration of microfinance institutions into the regular financial systems in developing countries? Those are three different objectives, and it depends on what you really believe is the core issue for microfinance to solve. And the creation of impact depends on what your mission is. And then you have to report on that. But how do you do that? There are fantastic initiatives. Incofin last week hosted a social performance task force meeting where the universal standards were presented on measuring or at least managing the social performance of microfinance institutions. A very great initiative. But most of the criteria deal with the social performance and not necessarily with the outcomes of what is being created. So impact is a very difficult thing to measure. And there are studies available, and Incofin actually presented last week a fantastic study that's not public yet, but it's going to be public, as Louis told me, on over-indebtedness in Cambodia. That is a great study that helps us to understand what really the impact is. Are we helping people, or are we sometimes creating more trouble by bringing too much money to a situation where it might not be needed? That's, by the way, not the conclusion of that study. So creating impact is also important for these institutional investors for another reason, being reputation. Because these large institutional investors, the pension funds, they are publicly exposed, and certainly the media, certainly in the Netherlands, but it also counts, I think, for other European, certainly for European countries, they are exposed to all kinds of risk. And for instance, in the field of agriculture, I recently discussed the reputational issue with large institutional investors like the BT Pension Fund, TIAA-CREF, one of the largest institutional investors in the US, ABP, and some more. And basically what they told me is, we're very interested in investing, for instance, in agriculture because it contributes to some of the food and production issues that we're facing in the decades to come. But we're not going to invest where it might be most needed, namely Africa, because we're getting basically accused of being involved in land grabbing and all that kind of stuff. It might not be true, but simply organizations like Oxfam are very, very interested in following what is happening on the ground and accusing institutional investors of being involved in all kinds of practices that Oxfam doesn't like. And I think the way out is not to really challenge these organizations in the media. What is much more needed is that we start a dialogue up front to see how we can prevent these organizations from getting involved in something like land grabbing. Because if we're talking through the media, then ultimately the reaction will be that private money, what is needed in the marketplace, will basically not be deployed to some of the good causes that we all think is worthwhile. The way forward. As I mentioned, it's a good thing that institutional investors enter the market. They bring private capital, market discipline, efficiency, and scale. But it certainly will not replace public capital. It cannot replace public capital. And it should not replace public capital. Because public capital, and particularly the efforts from NGOs, etc., is needed as the first step in that financial supply chain. Afterwards, private investors come in. There's hardly any private investor, and certainly not the larger private investors who are willing to take huge risk. They cannot. The pension fund of the ministers in the Protestant church simply have a fiduciary responsibility to look after the pensions of those ministers. That's their primary objective. That's their primary task and duty. But they can do something, having said that, they can do something that is positive. They can invest for the good, for the better of society, while actually remaining within the financial risk-return boundaries. And what is needed, therefore, is ultimately the creation of a sustainable impact investing marketplace, I would say, where these investors can find each other and they come in at different points in time. And that is, I think, a major step forward. So, actually, the Protestant minister was really proud of making his investment in microfinance, or that his pension fund basically made those investments. But to be honest, he could have been proud of something else, and that is the fact that that pension fund not only made discrete investments in microfinance institutions, but helped to build an infrastructure that ultimately helps us as a society to deploy sufficient capital to development. That is the major challenge that we're facing. In a situation where ultimately our public authorities are not willing or not capable to deploy sufficient capital to development worldwide, we will face the consequences of having to bring in institutional investors. And I prefer to bring in institutional investors in the sense that we're talking about pension funds, insurance company money, for instance, long-term orientation they have, instead of bringing in hedge funds or other private equity, venture capital. Sometimes it's very much needed, but it has to be responsible. It has to be responsible capital and responsive. This capital has to be accountable for what it does. Ladies and gentlemen, we are not there, far from that. There is a lot that needs to happen in the future. And one of the things is that the only constant, as I write here, the only constant is actually change. It is a bit of a contradiction in terms that change is the only constant. But it is what it is. And we can only use the dynamics that we see to ask for the right investments, for the right motives, in the right time. And that ultimately can mean that pension funds like those of the Dutch ministers can make a significant contribution to development. My final remark is on an organization Mr. De Picker already mentioned, and that's the Global Impact Investing Network, of which I am the European liaison. That is an intriguing organization that wants to bring those investors together that have an objective to create impact, positive impact. And actually, I would like to invite you all to have a look at that organization, what it can do, and maybe what it can do for you. So you can access that at www.thegiin.org. Thank you very much for your attention.
Is there already somebody who would like to start with the first question?
You were talking about pension funds, and a question, I work for KBC Asset Management, and a question that I ask myself, have there been any studies in how to provide a minimum protection level when pension funds would invest in these kind of projects? Because my impression of these investments is that it is a high risk. Of course, you don't want to take that in a pension fund. So is there any mechanism that you can put on that to protect a part of the money you invest?
Yeah, I do think, but that's basically integrated in the regulatory and supervisory practices that prevail. I'm pretty sure that happens here in Belgium, certainly in the Netherlands, where the supervisory authorities have basically issued a paper on innovative investing, as they call it. And what the regulatory bodies basically say is, it is allowed to invest for impact if you really know what you're doing. So you have to understand your investments. And that is why I'm calling for the professionalization of the sector. Because if you are able, or we are able as a sector, to provide pension funds, but also insurance companies and other institutions who invest for the long run, to give them guidance, to provide them with the tools that they can assess the risk of these investments, while at the same time making clear that these are institutions that work for our common benefit. Pension funds are there for us, and they are not usually required to liquidate their funds today or tomorrow, but their policies and practices have to be in place as if they were able or required to terminate the pension fund either today or tomorrow. So that's what coverage ratios, etc., are dealing with. Ultimately, what we're talking about is a long-term horizon. Pension funds and insurance companies know only one thing for sure, that they have long-term liabilities towards their pensioners, their insurers. And if we then develop instruments, financial instruments, that meet the need of those investors while providing them sufficient guarantees and certainly sufficient insight in what they're actually investing in, then it's not an issue that they invest in high-risk investments. Let's be honest. Most of the times they do so. They invest in hedge funds, they invest in private equity funds, etc. And if you look back over the last few years, we can safely say that microfinance, whether in debt or in private equity, has been one of the better asset investments they have ever made. If you compare it to regular private equity, they haven't shown the returns. Microfinance did. That's intriguing. So it's also about risk perception, making sure that they really understand what they're investing in.
Good afternoon. My name is Wietse Vroom. I'm working for Drabelis, an impact investing company. I think you presented impact investing as a balancing act between getting a good, stable financial return and also assuring impact. Now, I recognize that this may be slightly beside the central topic of your presentation today, but I was wondering if you could touch upon the impact assurance dimension in all of this for these kinds of large institutional investors.
Yeah, sure. And as I already mentioned, that's very difficult. There are assurance mechanisms. There is an organization called GIIRS, G-I-I-R-S, the Global Impact Investing Rating System, that actually measures the quality, the assurance of impact investment, and particularly of funds. Funds can apply for such a certification. In addition, I can refer to a very interesting website called TRASI. That's part of the Foundation Center, and TRASI is an abbreviation of Tools and Resources for Assessing Social Impact. And to be honest, it's rather shocking, I have to say, that you'll find more than 150 different tools that are available for measuring impact. They're not always measuring impact in a way that I would understand measuring impact, but nevertheless, there are more than 150 tools and methods available. It's very intriguing to see that, but the basic question is, what do you really want to know? And why do you really want to know that? Because it all starts, if going back to the minister, my minister, the one I was listening to, he simply wants to know what his pension fund is investing in and whether it has a positive effect. We can do all kinds of scientific academic studies, etc., which is something I do with my other hat on. But it's much more intriguing for that minister to know that these investments do make sense for the investees. That's basically what he wants to know. And this is also about basically being honest and transparent about what you do and how you do it. It's much more forward-looking than backward-looking. So we can conduct all kinds of academic studies, very important, but I don't think that ultimately they will provide the answer. Let me give you one example. There's a very intriguing book called Poor Economics by Esther Duflo and Mr. Banerjee. Fantastic book. I'm really fond of that book. But it talks about randomized controlled trials. And they basically show that, for instance, certain investments in Hyderabad didn't actually alleviate poverty. Fantastic. So that's what we know then. But now I want to make an investment in Bangkok. What can I say about that investment in Bangkok? Is that also not alleviating any kind of poverty? I wouldn't know. You simply don't know. So you have to always beware. Start with the question, what do I really want to know? And then try to find something like a functional tool that helps you to address the question that you have. And don't simply look at all the academic studies that are there. Yeah.
Good afternoon, Catherine Hawk from the International Federation of Cooperative and Mutual Insurers. I was wondering when you described the types of investors, the public and the private insurers, for instance, or banks, have you ever looked at the insurers that are mutual or cooperative, because they are basically on the market but feel less pressure from their shareholders? And at least according to ICMIF studies, they represent more or less 25% of the world insurers.
Yeah, I would love to welcome them to the space, I would say. I haven't done any studies. I don't have any research on the attractiveness of impact investing for mutual insurance companies or cooperative insurance companies. But I do understand that at least there is this common basis, this sharing of values, and that very often is a very good basis to start with something like impact investing. But I don't have any credible information or studies or whatever on that topic. But I certainly would encourage them to take the step forward. It's all what the Belgian Raiffeisen Society or Foundation is. The idea of Raiffeisen was, of course, okay, well, what I can't do individually, let's do that together. Let's do together what I can't do individually. That makes sense. So we are facing a few major issues with regard to water scarcity, with regard to food, with regard to climate change, etc. If we don't solve that together, we are probably faced with a world that is not as sustainable for our children as we want it to be. So stepping in also for your sector is quite important, I would say.
Yes, my name is Andres Arima, and I'm professor at the Catholic University of Louvain. Thank you, Professor Hummels, for your presentation. It was very, very interesting. And so you said a lot of things which are very, very interesting, and I noticed particularly your stress on professionalization and for governance. So my question, I have 2 points. My first question is, how many do you think, in terms of numbers or percentage, in Africa, for instance, microfinance institutions which are eligible, which may be considered as professional enough to meet the requirement of international investors? The second point is, as you mentioned, professionalization and the governance are the issue in microfinance. If you wanted to make impact, positive impact, you need to ensure that so not only you bring fund, but you also help for professionalization, for management, for risk management, for day-to-day work of microfinance institution. So how do you think international investors may do or should do to help to support microfinance institutions for more professionalization and better governance? Thank you.
Yeah, very intriguing questions. Thank you, Professor. That is very important what you're asking. First, let me start with your first question regarding the number, approximately the number of MFIs that qualify for professional investors. I do believe that we're talking about a bell curve here, more or less. So if you look at the bell curve, then you usually have something like 10% that certainly disqualifies, completely disqualifies, because those are the tier 4 microfinance institutions. Then you have an increasing number of tier 3 and tier 2, and institutional investors come in at the end of tier 2, I would say. Tier 1 is not really interesting, because then sometimes too much money is chasing simply money and not looking at what is really interesting in investing in microfinance institutions. We as an institutional investor, SNS, has some $500 million invested in microfinance worldwide, coming only from institutional investors. So there is an appetite, there is a possibility to invest with institutional money, but we definitely like to look at the tier 2 and the tier 3 microfinance institution, and that is actually quite a substantial size. So you have some other providers like Responsibility, etc. And Blue Orchard, they prefer to invest in the tier 1s. But the most interesting ones, also from an impact point of view, are the tier 2 and the tier 3. And actually, an increasing number of MFIs do have the capability and absolutely have the characteristics that professional investors can step in. Having said that, I think you're right in pointing to the need for further development, and that's when I want to call for collaboration between, for instance, NGOs and institutional investors. We need technical assistance. And very often these pension funds, because of the focus they have to give to financial returns, they don't have large budgets for technical assistance, but it certainly is needed. So collaboration might be a key answer here, and that could happen with, the collaboration could take place with the NGOs, local NGOs particularly. It could work with the national governments, both in the developing world as well as some of our national governments, basically, providing capital for development. So my last remark would be, indeed, a call to my own government. They have just initiated the idea of setting up a revolving fund for 750 million euros for development. That's fantastic. At least it sounds fantastic. But the fact that it should be revolving makes me concerned, because then apparently money is more important than development. And I would say, particularly for a public institution like our government, development should come before finance. Thank you.
I would like to give the floor to Loïc de Canière. He's the CEO of Incofin Investment Manager. And Loïc, thanks for your remarks.
Dear Mr. Chairman, ladies and gentlemen, dear Harry, you have provided us with a very excellent and interesting presentation of this new emerging asset class of the impact investments. And you also gave us a very interesting insight in the trade-offs that investors face, be it your Dutch Protestant minister or the Dutch pension funds. By the way, minister here sounds more like politician in Belgium, but I'm not going to quote Belgian ministers here. Let me give you some feedback from the point of view of a practitioner with quite some experience on the ground in impact investments. So Incofin is a Belgian-based fund management company. We are focusing most on microfinance. We manage 350 million euro of assets, but also expanding to agricultural finance and SME finance. My main feedback that I would like to give to your presentation is that I think we should be patient. I would like to introduce the dimension of patience, of time. Let me start with some figures. According to the JP Morgan survey, recent one, the universe of impact investments represents some $8 billion US. $8 billion US. When the first study about impact investments was launched in 2010, also by JP Morgan, they estimated the total universe of impact investments between 400 billion and 1 trillion US dollar by 2020. So we are far beyond the actual first estimates. Another study, CGAP, very recent. I don't know whether it has been published, but it was presented last week at our office in this internal meeting. Microfinance still represents 72% of the impact investments, while SME investments and agriculture represent respectively 15% and 7%. And impact investments in industries such as renewables, education, health, and housing are still rather marginal and do not exceed 7% of the impact investments. It is obvious that microfinance has demonstrated that there are opportunities for doing businesses with and by and to the benefit of people at the bottom of the pyramid. Business that is both profitable and generates social return. The concept of impact investments piggybacks on the successful microfinance model. Microfinance has been a source of inspiration to develop other profitable businesses at the bottom of the pyramid that generate social and financial return. And this is good, as microfinance does not at all solve all the problems for people at the bottom of the pyramid. The emergence of non-microfinance impact investments should indeed be encouraged. However, the building of a solid non-microfinance impact industry will take time, and it will be extremely challenging. I am convinced that the forecasts of the first JP Morgan report were just not realistic. But I agree that the market potential is huge. This is very encouraging for the future of less developed countries. I also acknowledge that there is a lot of entrepreneurship at the bottom of the pyramid in emerging economies, and that this entrepreneurial attitude creates great opportunities, both for the entrepreneurs themselves as well for investors. I'm not so sure that the propensity to entrepreneurship in our old European continent is of a similar high level. Perhaps this might partially explain why we see continuing high growth rates of 5% and more in emerging economies. Kenya, you were mentioning it. Whereas our Belgian minister and your Dutch minister, the politician this time, would consider a 1% positive growth already as a big success. We also need to be patient in another sense. When investing in individual portfolio companies that qualify as impact investments, investors need to be aware that a relatively long time horizon will be needed in order to grow the company and to generate a decent financial return. So we should not attract impatient investors that want to see double-digit returns after 3 years. Rather, we need investors that have a 7 to 15-year time horizon with reasonable return expectations. When talking about impact investments, I also would very much encourage to be more ambitious in terms of impact measurement, and you already mentioned it. Many actors have developed tools to measure the social intent, social performance of portfolio companies, but did too little efforts to measure the social impact, the social outcome of investments at the level of the final beneficiary. I regret that there is very little communication and synergy between academics on the one hand, measuring social impact with sophisticated statistical tools, the so-called randomized controlled trials, the RCTs, that are hardly understandable, and then the practitioners on the other hand. As you mentioned recently, we have cooperated as Incofin with a number of academics to do an on-the-ground study in Cambodia, and I think the results were very interesting, and I think there is more room for this kind of cooperation that would be to the benefit of all the players involved. And perhaps also our development finance institutions could also be part of this effort. Finally, I agree that impact investments can give a clear signal to financial markets that mainstream financial institutions should also integrate social, non-financial impact in their offerings, also the traditional pension funds. I'm optimistic about this as I see more and more financial institutions and large corporates integrate these concerns in their mainstream operations. Perhaps in the short term, this is even the strongest outcome of impact investments. In order to make this world a better place, we don't need sharks, but we need patient investors that target balanced financial and social returns. Thank you very much.